Are you an established small business owner or aspiring entrepreneur? Would you like professional advice to help your business grow and succeed? Well, look no further. The Virgin Islands Small Business Development Center is the territory's #1 resource to move your business forward. Enjoy no-cost advising, low-cost training, and technical assistance from experts in both the public and private sectors. The VI SBDC is nationally accredited and sustained by the University of the Virgin Islands and the U.S. Small Business Administration. Visit us at our locations on St. Thomas, St. John, or St. Croix, and follow us on social media at VI SBDC. For easy access to all our training and networking events, be sure to join our newsletter and download the VI SBDC app. The Virgin Islands Small Business Development Center, here to help your business start, grow, and succeed.
Good morning, everyone, and welcome to the VI SBDC's hosting of Securing an SBA Loan for Your Business, How to Get Approved. Today's session will educate participants on how they can prepare a strong application package to secure business funding. Our lead presenter for today is Mr. Wayne Huddleston, SBA Senior Area Manager for the USVI. Here's a friendly reminder to put your questions in the chat, and they will be addressed by the presenting team either directly in the chat or later during our question and answer segment. A copy of today's presentation will be attached to the pro-survey email. We encourage you to take a few minutes after this live event to fill out the survey that lets us know how we're doing. So without further ado, Wayne, the floor is yours.
All right, thank you, Sharika. Thank you, everyone, for joining today. As Sharika said, this is going to be a webinar on how to secure an SBA loan for your business. That's the title of this webinar. I am going to talk about what the SBA guarantee is and how lenders can leverage a guarantee to help you with a loan. But the real meat of my presentation today is going to be about how to secure a loan, whether that is an SBA guaranteed loan, whether that loan is guaranteed by some other government agency or program, or really just if you're trying to walk into a bank and get a loan without any guarantee, you just need a loan for your business. I'm going to cover the specific things you need to know to get an approval on that loan, regardless of whether it's SBA guaranteed or not. What we're going to be covering applies just across the board. So let's see. So here's what we're going to talk about. We're talking about the sources of capital. A loan is just one source of capital people can use to fund their business or grow their business. We're going to spend a lot of time talking about something called the 5 C's of credit. Then I'm going to talk about what government guaranteed lending is, specifically SBA lending. And then I'm going to show you some tools on how you can find a lender and what that lender is going to need to see from you, and then some technical assistance available. And then I'm going to leave plenty of time for anyone to ask any questions. So at the end of this, or as we're going through this, if you have any questions that pop up, please feel free at the end to either unmute yourself or type those questions in chat. If it's during the presentation, go ahead and type it in chat and we can get to it at the end. But I don't want you to leave today's presentation still unsure about what you need to do to get a loan. What I'd like to do first is show just a short video. This is about 2 minutes. This really kind of ties into the sources of capital that most entrepreneurs look to, whether they're starting a business or growing a business. Gives some pretty good insight there. So I'm going to play that real briefly.
Most young companies need money, which may or may not come as a big surprise, but they do. The number one source they get money from is from their own savings. Whether it's a few $100s or even thousands of dollars, that's what we tend to tap first. And a lot of companies don't get money from any other place. They get money from their own savings, and then after that, they're lucky enough to be cash flow positive. They're profitable. So we talk a lot as if all companies require all sorts of external capital, and the reality is that more than half of young companies get all their funding from a combination of founder savings and then cash flow from the business, and we're out of here. Next up on the list is another one that catches, I think, people by surprise, and that's credit cards. Almost every young company you can think of, to one degree or another, was funded on credit cards. And it is the single largest source of capital for young companies after founder savings. And then the next place where they tend to get money is from friends and family. After I've tapped out my credit card and I've used up all my savings, I turn to people I know and say, hey, will you help me? And that's the third biggest source of capital. And then the next place is banks. And the banks are a totally weird situation because with banks, they get a lot of attention, but they actually fund very, very few young companies. But it's not their fault. You have to think about the way bank lending works and how shareholders want banks to lend. They want them to lend money against secured assets. And young companies don't have any secured. They have nothing to secure it against. And the joke in the industry is you can get all the bank funding you want as a startup as long as you don't need it. And then the last piece is venture capitalists. They get the lion's share of the attention, which in some ways is warranted. You know, your Googles and Apples and FedExes and many others all have venture capital money inside of them. But the reality is, and this is from Kaufman Research, less than 20% of the fastest growing companies in the United States took any venture money. And that's not because the VCs wouldn't give it to them. It's because they didn't want it or didn't need it, because they had all those other sources. I don't need money, and I certainly don't need money on these terms. Because, you know, venture capitalists, unlike banks, they don't lend against secured assets. They give you money in exchange for shares. So they take some of your company away. So my answer is if you don't need it, definitely don't get it. There's no question the venture industry has become staid. The irony is it's intended to fund disruption, and yet it's an industry that had become complacent. And interestingly, over the last 5 or 6 years, we've seen the emergence of other mechanisms for funding, like AngelList, like these kinds of peer-to-peer funding sources, as people increasingly provide capital in smaller amounts, but more people doing it directly. Having said all of that, though, venture capitalists are hugely important for those young companies that don't have access to bank money, but are growth companies. They have the prospect of being a $5 million or a $10 million company in a couple of years, and they need that growth capital to get there quickly. So it's a race. And the way you play the race is by getting money from people like venture capitalists who give you the money so you can compete with other people who are racing as fast as you are. If you can run a company off cash flow and some combination of credit card, your own savings, and friends and family, you know, Bob's your uncle. Run. You know, keep all the equity, because, you know, there's no better thing than being in full control of your own destiny.
So that was just a short little video to talk about the sources of capital for businesses. That focused primarily on startups or very young businesses. I'm not sure how many of you in this presentation are startups or very young, but it is important to know that a loan is not necessarily the first choice you should be considering when you're starting up or you don't have a lot of years in business. There are a lot of other sources of capital. But I know a lot of you also have been in business for many years. You're just trying to secure a loan to grow your business. And a lot of those still apply. There are other avenues for securing a loan, or for securing capital. But as you grow, a loan becomes a little bit more of a more frequently used option. And we're going to talk about that today. But I do want to, again, mention there are other sources of capital. As mentioned in the video, there are personal funds, personal savings, friends and family, microloans, other things, venture capital, and they all represent different channels you can use to fund your business. Now, this is a graph that shows where startups get most of their funding. The vast majority get them from personal savings and credit or friends and family. Very rarely will any startup get money from investors or bank financing through a loan or venture capital. It's just very rare to happen. Now, as a business grows and it's no longer a startup, far more and more will get their financing from bank financing or an investor or capital or something like that. But as a startup, it's very rare for that to happen. All right, I'm going to talk primarily now from here on out about lending. And we're going to talk just about how to secure an SBA loan or really any loan for your business. Some things you should know up front, though, is that 100% financing is not a realistic option. Lenders are not willing to 100% take all the risk in your venture or your project. They are going to want to see that you can put something into it and be partners with them on financing. And on the financing of your project. So, if you need $100,000, say, don't expect that a bank is going to give you $100,000. You're probably going to need to come up with some of that on your own. There are no grants for general business purposes. Your personal credit history is very important, so you're going to make sure you know that history and know what your score is before ever even thinking about talking to a lender. A lender is most likely going to require one or more personal guarantees, and SBA does not make direct business loans. SBA provides direct loans in times of disaster, but for regular business purposes outside of a disaster, SBA is not making a direct loan. We're providing a guarantee on that loan, which I will explain later. Okay, the primary thing we're going to talk about today is something called the 5 C's of credit. This is a general framework that all lenders use to evaluate your loan application. Each institution will vary on what is acceptable for each attribute. For instance, some may be more comfortable in a particular industry than others are. Some may be more comfortable in lending to early stage businesses than others. It just all depends on their expertise on staff, their history, all sorts of other things. However, they're all going to look at this framework in some way. Just the amount of emphasis that they put on each part of this will vary a little bit. But we're going to talk about each one of these in depth. But the 5 C's, just a quick overview, are character, capacity, capital, collateral, and conditions. Character is just your reputation and trustworthiness that's assessed by a lender. Your capacity is your ability to repay. Capital, the amount of funds that you have and that you're going to put in, or your team is going to put in. Collateral are assets, buildings, cars, equipment, whatever that the lender can use to secure the loan. And then conditions is what's going on in the marketplace, what is impacting loan terms, industry trends, those types of things. But I'm going to go into those in a little bit more detail. First one I'm going to talk about is capacity. I hesitate to say that this is the most important one, but oftentimes lenders will say this is the most important one because at the end of the day, it just reflects your ability to repay the debt. And that at the end of the day is all that really matters. Can you repay a loan that they give you? This is largely assessed by your financial statements. They're going to want to see your cash flow statement, your balance sheet, your projections, all sorts of things. They're going to see what this are, how long has it been operating, but they want to see your historical cash flow and then understand how much debt you have already, compare that with how much debt you're asking for and is going to take on. And they want to do a deep analysis to understand whether, if you receive all this debt, is it realistic to think that your history of cash flow in your business is going to cover your debt and allow you to remain profitable as a business and continue? Or is it going to saddle you with too much debt? So they're going to make a very careful analysis of your capacity using your financial statements. So you need to make sure you had those financial statements together. You're also going to make sure you have your credit score. That also is a reflection of your capacity to repay the loan. This varies. A lot of people will ask, what is the score needed to get a loan? And there is no just one score that automatically gets you a loan. That what they need to see will vary a little bit based on other factors. However, If your score is below 650, I wouldn't start the process with a lender because it's probably not realistic that you're going to receive a loan, even if other conditions are really good in your loan package. If your credit score is below 650, you want to get into the middle 700s or better if you can, or at least the low 700s, to at least be in a point where you can talk with a lender. And have them have your credit score not be an issue that could prevent you from getting a loan. The next C is capital. And this is simply the amount of money that you're putting in to a loan application. As I mentioned before, no lender is going to be willing to assume 100% of the financial risk for your project or your venture or your business. They're not going to, it's not their business, and they're not making the decisions day to day. So they're not going to take 100% of risk. If they want to see that you are putting in something to show that you are putting something at risk, just as they are, and that you are willing to put that in. 20% is a typical minimum amount. There are times when they can maybe take as low as 10%, but usually they're looking for 20%, 30%. The more you can put in, the better. So make sure you have, before you talk to a lender, make sure you have already assessed what you can put in and have set that aside to show that you can do that with a lender. Collateral, as I mentioned earlier, is another C, and these are simply the assets that can be pledged as security. Simply just like in a home loan, the bank owns your home until you pay it off. If you own a car, you're financing it, the bank owns your car until you pay it off. This is an asset that if you stopped paying on your loan, they can go and secure that and then sell it to recoup their losses on that loan. And now, just because you have collateral, there are, I've heard people say, well, I have enough collateral, whether that is a piece of land or a building or something that 100% secures the loan. But the lender still won't give me the loan. And they wonder, like, well, if it's 100% secured, why is it a big deal? I should be able to get the loan. Well, there are a lot of other factors that go into that. So, but one of the main things is it's not as simple as a lender, you don't pay the loan and they secure your assets. That still costs them a significant amount of money. They have to go through attorneys, they have to go through court systems. Here in the Virgin Islands, that is a notoriously long process. Many lenders sometimes consider collateral not really as valuable here in the Virgin Islands as it may be in other places because it's so hard to secure that collateral. Then they have to sell it, and they're not in your business. So collateral is important, but alone, it cannot make you get to a yes and a loan. But you're going to have some collateral to present to a lender when you make a loan application.
So Wayne, we have a question. Can you use
Sure.
the asset being purchased with the loan as collateral?
Yes, you can. However, it depends on what those assets are. So if you're securing a loan or you're requesting a loan to purchase a building or a piece of land, or a very durable, widely used piece of equipment, many lenders will consider that as working for their loan and meeting their collateral needs. However, if a business is using inventory for their business as collateral, a lot of businesses or a lot of lenders will not take that as collateral because they're not in your business. So they don't want to try to resell your inventory. They just want to be able to turn around with something that is easily turned into cash for them. So yes, the collateral that you present could be what you're purchasing with the loan. You don't necessarily have to have that collateral possessed by you before you walk into a lender.
And someone is also asking, what if you don't have any buildings, cars, or?
If you don't have anything before the loan, then I would try to find a way that, you are securing those kinds of assets with the loan, but you're going to have to try to find some sort of collateral. And if you don't have anything before you go to loan and in your loan application, you're not purchasing anything that can be used as collateral, I would maybe take a pause and relook at what you're doing and reassess on the 5Cs to see if you can secure some kind of collateral, or somehow show that in all the other 5Cs, everything is looking so strong that you may be able to overcome that with a guarantee. All right, if there aren't any more questions about collateral, we'll go on to conditions. That's another C in the loan. Conditions are really the environmental conditions. What's going on in the economy? If you're opening a business in Puerto Rico or the Virgin Islands, they want to know that you understand that market specifically. You understand your competitors, your competitive environment. That is, if you're the type of business that relies on suppliers or logistics supply chain, that you understand what happens there, and that you can assess that if there are any problems, how you're going to overcome that. So if your business is reliant on the tourism industry and something happens to shock that, and maybe stop cruise ships for a period of time, or it's seasonal, or if you're relying on inventory to come off island to get here and something happens in the supply chain, how you're going to overcome that. They want to make sure that you have very thoughtfully assessed what the marketplace is and shown how your business is going to be successful no matter what. And then they also want to make sure you're prepared to mitigate them. That is done through your business plan. So you should have a very well thought out business plan. It doesn't have to be 30, 40, 50 pages. It just needs to be very well written and very well thoughtful. Has financial statements, projections, analyzes your marketplace, your competitors, your business, shows why it's going to be successful. So they're not the experts in your business, but you're going to need to show them that you are and you know how to make it work. And then finally, the last C is character. Out of all the other C's, this is one that is less quantitative than the others. It is harder to put a number to or put into a formula like you can with the other parts of the C's. It's really just an overall opinion that the lender forms on the borrower's trustworthiness, credibility, integrity. It's really assessed during every single interaction that you have with a lender. So when you talk to a lender, when you say you're going to show up for a meeting, show up for the meeting. If you can't show up, then make sure you call in advance or reschedule or something. If you're going to provide some financial statements within a certain time period, make sure you do. And make sure you're just, honest broker with them the entire process. You also want to make sure that, I guess you can't necessarily change what may be out there about you, either online or your reputation in the community, but you certainly should be able to address anything negative that may come up in a report. I'm going to give two quick examples about character that kind of highlight this piece because it's often very much overlooked, but can often be the most important C for some lenders in a deal. So I'm going to give an example from an experience I had before I moved to the islands. I used to be the director of a small business development center. And we would have clients come in on a frequent basis, many times looking for loans or capital to start or grow their business. And in one particular week, we had two business owners that came in, and the direction of their ability to secure a loan and secure capital went in totally different directions that I did not see coming. So the first one who came in was a business owner who had not started his business yet, which is already a major red flag for lenders who are trying to provide a loan to a business. If there's no, as I mentioned before, if there's no history of performance and there's no financial statements to go by, there are lots of lenders who just say simply, we're not going to go any further. Like, you just come see us when you've been in business for a few years and we can look at financial statements. So he already had that problem. Then he quickly explained the business to me as a sewing machine business, and he needed money to open a physical retail store, which in my mind, I didn't understand that. I didn't know why sewing machines could be a lucrative business at all, why you need to have a sewing machine store for that. It just didn't make much sense to me. And then he said, oh, by the way, I recently had a bankruptcy, so I'm struggling to really find a lender who will help me. And I just thought to myself, this is not going to work. But I connected him with one of our business advisors, and they began the process of really kind of doing a deep dive and figuring out how we could help them. A couple of days later, I had a business owner come in. This was one I had known previously because he had had a successful venture that had started up a couple of years prior. This was in the healthcare industry, which is a very attractive industry for many lenders. He had already had a product that was up and running. He had had lots of investors already, millions of dollars worth of investment in his business. He had technology patents on physical therapy devices that could be worn or implanted in patients that would report back to their doctors or their physical therapists on their physical therapy progress. So for instance, if a therapist or doctor told a patient, go home, put no more than 50% or so weight on your knee during this time, move it this much, this frequently during the day, but no more than 90 degrees or whatever it may say. Those can be kind of complicated directions for a patient sometimes, but if they had this device on or implanted in them, the doctor could actually monitor their progress remotely from their office and see, oh, the patient woke up this morning, they put too much weight on their knee, let me call them and let them know, change that, or they're doing their movements good, so I'm going to call them now to increase that range of motion. It could really help with the physical therapy process. This business owner had patents. He had lots of doctors' offices that were very interested. He was at the point where he needed to ramp up production and needed to add on to his facility to grow the business. So I thought to myself, this is going to be great. Lenders are going to love me for referring this to them. And we started referring them out to lenders and starting that process. Fast forward about 3 weeks. And one business got money and the other one did not. And it was not how I expected it. The sewing machine company, the lender called me and said, Wayne, we were unsure about this business owner, but he had a lot of things going for him. One, he had an exclusive arrangement with Sanger, who is a top distributor of sewing machines. So he had his own territory that was already set aside for him. They were providing a lot of help in growing the business. They could provide a lot of background on how successful these little franchise operations are. And one of the biggest things was the bankruptcy. But he said, he was very upfront. The business owner was very upfront about the bankruptcy, went into great detail on how that bankruptcy happened and how he has put in things to mitigate against that ever happening again. And he said, I had multiple meetings with this person, and he was just very honest the entire time. I just trusted him. And so we're not going to get a loan to him, but I am going to give him a $100,000 line of credit, and that is going to get him what he needs. So we're going to do it. And so that was successful. And this business owner was able to open up his business and get going. A few days later, I got a call from another banker about the healthcare company. And he said, Wayne, this one was great. On paper, it looked great. He needed $3 million. We were excited to do it. We began doing our vetting process. They had cash. They had collateral. They had good credit. They had all sorts of things going for them. He said, but in the process, we ask a lot of questions. And in the application, one simple question we ask is, have you ever had a driving under an influence ticket or offense in the past? One of the business owners, one of the partners in the business had, about 10 years earlier, had been pulled over for driving under the influence of alcohol, was issued a ticket and some fines. He thought he had that expunged from his record. It happened a decade ago. He did not want that to jeopardize the company's chance getting a loan, so he did not disclose that on the loan application. The lender told me, he said, Wayne, we could care less whether they actually had that kind of offense or that kind of criminal history in their past. We just asked that question because we just want to see, are they trustworthy? And he lied. He told us he didn't when he did. And if that person is not going to be truthful about something like that, we're talking about $3 million. We're not that comfortable. We're not comfortable providing a loan to someone who would lie in an application like that. So that sunk that deal. And that really set that business owner back. And in both of those instances all came down to character. Character was able to get a deal done when there were other problems with the 5 C's and in their background. And at the same time, character was able to sink a deal when everything else looked great in a deal. So even though this is not as quantitative, I'd like to spend a little bit more time on this part of the 5 C's because it is very important and it is often overlooked by prospective borrowers. All right,
Thank you for
putting
that,
that all
Wayne.
together. Yes, go ahead.
We actually had a question that spoke to that slide on character. Can a
Okay.
resume be used to assess character personally and business-wise?
Of course. You should be putting your resume in there. They're going to be looking at your background. That helps them get a bigger picture of who you are and what you have done in the past. And then they can use that to perhaps, you can have references on there in your resume. They may check into other people if they don't know you. But yeah, resume is an important piece of assessing your character and also assessing your expertise in the business you're trying to run. So resume kind of comes into play in your business plan as well, but also assessing your character. So yes, absolutely include that. Okay, so if a business is lacking the one of the C's, it doesn't really mean the loan is denied. Most people walking in to secure a loan have issues, and so that's normal for lenders. And in fact, 75–80% of the people walking in to get a loan have so many issues they just can't get a loan done or can't get to a yes. But there are times when someone has a deficiency in maybe one of the C's, maybe even 2. And that's where our SBA guarantee can come and help in that. But you want to make sure you understand those 5 C's. And, they may be able to get some other support to help in that. Or they can refer you to a partner if it's just not at a point where they can get to a yes on a loan. They may refer you to the 5 C's. To an SBDC to work on it a little bit more. But usually if a prospective borrower is lacking in multiple C's, I would say 3 or more, it is not really realistic to expect a loan or credit approval. What I highly, highly recommend for everyone, before you walk into a lender, before you talk to a lender or start your application process, pull out a sheet of paper, write the 5 C's down, and seriously assess where you are in those 5 C's. Do you have financial statements? Do you know your credit score? Write that down. Do you have collateral? What is that? Do you have cash to put in? How much is that? All sorts of things. You want to write all those things down and then assess those. Does this put me in a place where I can be a good prospect for them? And then take those over to an SBDC and have them evaluate that before you walk into a lender, and they can help. You don't have to have them all perfect, but if you have at least most of them good, then an SBA guarantee can help. And how does that SBA guarantee help? That simply just reduce the risk for a lender. There are other guarantee programs. USDA has a guarantee program. There's a local one here in Virgin Islands called SSBCI. There are other different types. We all work generally the same. At SBA, what we are doing is we are assuming risk for that lender anywhere from 50% up to 90%, depending on the type of loan for that lender. And essentially just saying to them, look, if your borrower stops paying, we'll pay you 90% of the loan value or 50% loan value, depending on what it is. There's still risk for the lender, so they're going to take some amount of risk and they still don't want to lose money. So we're not going to take all the risk. But it does help them oftentimes if there's a small deficiency in the loan in one of those C's. We have a program called Lender Match, which I'll talk about a little bit more here in a little bit. And I want to emphasize that all the lenders here in the Virgin Islands are authorized to leverage the SBA guarantee and have in the past to get deals done here locally. The advantage of it is really for the lenders. It just makes it less risky for them, and it guarantees that portion. For you, that benefit trickles down to you because that allows you to get a loan without as much of a down payment or as much collateral on hand if you're short on it. You're going to get reasonable interest rates and longer terms. Now, our rates are pretty much set. So they are tied to the federal funds rate, which is pretty high right now. So The rates are still going to be high, but you can be assured that it's not going to be in the predatory lending area of rates, because we have specific maximums that lenders can charge with those rates depending on how much the loan is and what it's for. And there are not going to be any balloon payments or demand clauses. You can use an SBA-backed loan to really do almost anything: start or grow a business, purchase a business, get a line of credit, purchase inventory, land, export, whatever. Now it's still up to the lender to use the guarantee. We cannot at SBA compel a lender to provide a loan to a startup. If they're not comfortable providing a loan to a startup, even with our guarantee, they don't have to. We're just offering this as a way for them to reduce their risk and hopefully encourage them to do loans in some ways. Now, there are some instances where a lender cannot use an SBA guarantee. One of the more frequent ones is to engage in what we would call speculative or passive businesses, such as purchasing real estate that you rent out, or like Airbnbs and those types of products. The SBA considers those to be passive or investment type properties. And you cannot use public funds or a public guarantee to support that. That doesn't mean you can't get a loan. Lenders can provide loans on that all day long. They just can't use the SBA guarantee for it. And of course, anything that may be considered illegal, for instance, federally wide, marijuana businesses are still illegal, even though local laws may be different. And again, that's not to say that a lender couldn't provide a loan or you can provide some capital for that. You just couldn't get an SBA guarantee for that.
Wayne, we have two very different questions in the chat.
Okay.
The first one says, can you please talk more about your initial gut instinct, please?
Sure. When we were talking about character, talking about the initial gut instinct, that is just the person that you're going to be meeting with at the lender's office. Typically, their title is going to be business credit officer or business officer or development officer, something like that. The person that is going to be putting together your loan package. They have a gut instinct about you that is formed more with more interaction. So, for instance, you walk in, first instinct, you're late for a meeting, you don't seem really prepared, you don't seem to really know your business. You're like, I'm not sure that this is really going to work out. Even before they've looked into any data, any financial statements, any credit rating, that just forms a gut instinct for them. So, a gut instinct is just all, basically your interaction with people. And of course, that can change with more interactions, but you want to make sure you present a positive image of yourself and have a good presentation. Another thing that, I can touch upon related to gut instinct is the complexity of your deal. So I have seen multiple times where a business owner will try to get a loan from a lender and their deal is very complicated. They're trying to use the funds to operate totally different kinds of types of businesses and do kind of weird things with it. That just makes a lender feel very uncomfortable and uncertain about what your true intentions are with a loan. So the more you can simplify what you're trying to ask for and what you're trying to do with the money, the better. That just creates a good first impression and a good gut instinct up front. You said there was another question, Sharika?
Yes. The next question is, if you are a sole proprietor, you would not have a financial statement. What can you use instead?
Well, if you're a sole proprietor, you absolutely should have financial statements. You can have financial statements through QuickBooks. Just because you are the only operator, maybe you're the only employee and the only owner of the business, that doesn't mean you shouldn't have financial statements. The business itself still should have something. If you have not set up any financial statements, if you don't have a separate bank account for your business operations, then you can show your personal financial statements to show this is how money's going out for the business, this is how money's going in. The lender may say, well, we can make this more of a personal loan based more on your credit, not so much a business loan. But they're still going to need to see something to show if this loan is for this purpose and it's for a business, how is that business making money? Otherwise, it's a startup. And if you are a startup, yes, you don't have the financial statements to show, then a lender is going to want to say, okay, let's look more closely at your business plan, how well you've analyzed how this startup is going to work, what your projections are. Let's look at your expertise. Do you know what you're doing in this type of business? That type of thing. So hopefully if you're a sole proprietorship that has been operating for a number of years, that you are utilizing QuickBooks or some other form to put together some financial statements, or you have an accountant that's well worth the money, or something like that.
Thank you. And 2 more questions came in. Can rental property be used as collateral?
Sometimes, usually in a general way, no. Rental property cannot be used as collateral. Sometimes a lender will make an exception. So if you have, for instance, if you have a very long-term lease on that property, say a 20, 30-year lease on that property, and you're trying to get a loan, then yeah, that lease could cover the term of your loan. So ideally they would not they would not need that, but they're still going to need to find a way to get some sort of collateral that you own and that they can get. So if you have a lease that doesn't really do that for them because you quit paying your loan, then the lease is canceled, everything's done, and they're left on the hook as a lender. They still can't secure that property. So unless maybe the lessor is willing to come into this and say, okay, I'm willing to pledge this to you as an additional guarantor on that loan, they could help out. But as a general rule, if you're leasing, anything you're leasing doesn't really count.
And that goes to the second question. If you have a piece of land in your name and not the business name, can you use it as collateral for a loan?
Sure. You're just going to have to sign on and show that you're going to personally pledge that as collateral in that loan and sign a statement to that effect. So, and in fact, if you have a friend or family member that is willing to do that for you, you can do that. It's just they need to have it somehow attached to that loan. All right, so these are lenders here in the territory. You can use really any lender you want, but I do want to emphasize that it's always best to start with a local lender. The reason I say that is because it's best to start with someone who knows you. So think of a lender as simply just a person. And so if you walk up to some stranger on the street and say, hey, I need some money, they're probably not that really inclined to even consider you at all. But if it is a friend of yours, someone who knows you, has a relationship with you, knows about you, they may be willing to say, yeah, let's talk about that. What do you need? Let's talk about this a little bit more. And it's the same with a lender. So if you are already banking at one of the local lenders, it's always a good idea for your business to walk in, talk to them before you ever need any money. So for instance, if you're banking at Popular, you'd want to go in and say, hey, who's the business banker here in this area? I'd like to set up a meeting and talk with them. Just go in, introduce yourself, say, hey, this is what I do. This is, my accounts with your business. Here's my plans in the future to grow. I think maybe at some point I'll need something. And I just want to introduce myself and talk with you about what my needs may be in the future and how you may be able to help. And they may be able to have some other solutions in the meantime. Maybe they can help with your cash management products or some other things in your bank account. They can pull those up. But they will genuinely appreciate the fact that you are walking in advance without your handout saying you need money right now, to get to know them as people and to get to know the bank and them know you. So that later on when that time comes, you've already built a relationship with them. Ideally, they've already talked about what kind of things they would need to see on a loan application. They're familiar with you. it just helps that process go a lot easier. So I always recommend starting with a bank with which you have an existing relationship. But when you come time for an application, it's always a smart idea when you're pulling that information together from everyone to shoot those out to other lenders as well, because they may be able to move, another lender may be able to move faster, another lender may wish to try to bring your business from that other bank over to their bank, and may be able to get you a better terms. So it's always good to look at multiple lenders, but start building those relationships early.
Another question, Wayne.
Sure.
Can you present community members you've worked with closely as character references?
Sure. Now you can present them, and they can talk to them. They may or may not wish to talk to any of those character references, and they may or may not assign that as any value in the application. For instance, if I'm trying to get a loan and there are maybe some negative things either in my credit report or out there online about me, or there's some negative history about me, but I say, oh, no, talk to my friend here. He thinks I'm a really good guy. I'm like, well, okay, well, that's your friend or that's your family member. So it may not carry a lot of weight. But it is absolutely worthwhile. Say, hey, here's some references. What really carries more weight with lenders is if you're trying to get a loan, your customers or your suppliers or people with whom you have a business relationship with, provide those to the lender, and they may be more interested in speaking with them to say, okay, how long have you been working with this person? Do they provide good service? Are they paying you on time for their services that they're getting from you, whether it's logistics or some other thing for the business? It's better to have references and character references that have a business connection with you in some way, more than friends. But any reference you provide can help. All right, lender match. I'm going to talk briefly about that. So there are the local lenders, as I mentioned. There's also this tool on our site called sba.gov/lender match. It's really just a simple tool to connect you with lenders. What we do is we have many lenders across the country that utilize Guarantee. We have this portal that they can go into, and they put in their parameters of the kinds of loans they want to see. There are many lenders outside the territory who say, I am willing to look at deals in the Virgin Islands, provided they meet these parameters. Some lenders may say, I only want to see people who have been in business for a while, or I only want to see people requesting a loan that's a minimum of this size or something. So they'll put those parameters in. On the website page, you go in there as a borrower, you put in your name. We don't ask a lot of questions. It may be like 15 to 20 or so. It's very easy. Your name, your business, how much you're asking for, what it's for, how long you've been in business, those types of questions. When you submit that, submit those questions and hit enter, that immediately gets distributed to any lender for whom it meets their parameters. They get to see that. Within 24 to 48 hours, they will either reply to say, yes, I'm interested in talking to that prospective borrower more about this deal, or not. And if not, you won't get any reply. But if there is a yes, we will just connect you or connect that lender with you. We're not doing anything else in the process other than making those connections. There have been multiple businesses in the Virgin Islands who have signed up on Lender Match, found the lender, some in the territory, some outside the territory, and were able to get a deal done for their business. One thing I would recommend, if you are going to use Lender Match, you want to be sure to fill all the fields in completely. You don't want to leave things blank, because as I mentioned, that a lot of lenders will have filters on these, and if you leave parts of it blank, they won't even see your request. So make sure you fill it all in. Make sure you're honest in what you put in there, or at least to the best of your ability. And that can be another tool to connect with a lot of lenders. Putting this in here because a lot of the lenders I asked them, what are the biggest obstacles you have to providing a loan to Virgin Islanders? One of the biggest things they say is the financial statements. They're just not there. Either a business does not have the financial statements, and so they can't even assess them, or they're not very well put together. So you want to make sure that you can put together these basic financial statements, a balance sheet, which is just a snapshot of your business that shows any assets you have, any debts you have, and just shows that to a business officer or a lending officer. You will show an income statement that shows your revenue and expenses and profitability over a specified period of time, and a cash flow statement that shows the sources and use of your cash, as well as the change in your amount of cash that you have over a specified period. These are important. There are some lenders who just really can't even do anything with your loan request if you don't have these statements, because they put these into specific formulas and it allows them to either go forward on the loan application or not. So you want to make sure you have these statements. If you have QuickBooks, you can put those together really easy. Or there are plenty of accountants and bookkeepers in the territory that can put these together for you. But you want to make sure you have those as you go in. Now, if you're a startup, there's a lot of things you don't have, but it would still be good to show like your projected income, your projected cash flow, and what you project to be your balance sheet. So you'll still want to have those. It is important to know your credit score. You should never walk up to a lender or walk into a lender's office or start an application and not know what your credit score is. These are the three big reporting agencies. Anyone can pull their score. There's lots of ways you can get it for free. You can go to MyFICO. You can go to annualcreditreport.com. There are all sorts of ways to not only get your score, but then get the level of detail needed to see what may be impacting your score in a negative way so that you can address that before you walk into a lender. But it is very important to have a good credit score, and especially to know what your credit score is before you ever talk to any lender. And you're going to make sure that you have, as I mentioned, these statements. You're going to want to make sure before you walk in, you want to increase your chances of securing that loan by having a business plan already put together, having your financial statements and expense sheets and projections already put together. Now, there are a lot of tools you can use and resources you can use to help you with those. The SBDC here, SCORE, has a lot of great online templates that you can use to just plug in your information on a business plan or your financial statements. And if you're a veteran-owned business, there's a resource in Puerto Rico, but also helps in the Virgin Islands, called the Veterans Business Outreach Center. All of these are free of charge. All of these can help you in a bunch of different ways. Just to key in on one here, since we're at the SBDC, SBDC can help in a lot of ways. I tell people, if I was starting a business today, I've owned businesses in the past. I've been with SBA for many years. I've run a small business development center. I've seen lots of businesses fail, and I understand what makes them fail. I've seen lots of businesses succeed, and I understand what makes them succeed. I would still walk into a SBDC and share my idea with a business advisor, if for no other reason, just to get objective feedback and what they think. There's a lot of your friends and family that will tell you, oh, this looks great, go for it. But you want to make sure you get some objective feedback of someone who doesn't really have a stake in your business to tell you, yeah, this is a great idea, or yeah, this is a really bad idea, and here's why. So they can assess the health and feasibility of your business. They can help you in the business plan. They're not going to write the plan for you. You need to know how to write it, but they can help assess it for you. They can help you with templates. They can help you kind of think through the portions of that plan and get it done. They can provide market and industry research analysis, the kind of analysis that you would otherwise pay a lot of money for. They can provide for free. They can review your financial statements just the way as a lender would. They can help you prepare your loan application. Again, they're not going to write the loan application for you. They can help you package it and kind of look at everything to say, okay, either you have everything or you don't, and here's what you need to put it in there. Let's build this together. They can help you with that. They can also connect you with government agencies that may be able to help and just give you general expertise in business management. A really good free resource. There's also resources at SBA. If you go to sba.gov, we have something called the Learning Center, where we have a lot of pre-recorded sessions ranging from topics such as marketing or government contracting or accessing capital or what. We have a lot of really good resources on there. And you can always reach me. Best way to reach me is my email, wayne.huddleston@sba.gov. I can typically respond to you within a day, or connect you with someone who may be able to help you further from there. So, all right, that's it for my presentation. I will stop sharing my screen and open it up to any additional questions that there may be.
Okay, so we have questions in the chat. Can you please elaborate on how LLC and LLD tax structures may help you?
So the structure of your business, that can be a whole presentation on its own. But the structure of your business can impact tax implications for your business. But really, one of the bigger things is the liability and risk you have in a business. So, for instance, if you're a sole proprietorship and it's just you have personal liability in your business. So if something happens and someone either hurts themselves or think you did them wrong in some way, they can sue you, and they can sue you as a person and go after your assets. If you're not protected right in the structure of your business, either through a limited liability or through a C Corp or a partnership in some way. They all have differences in the amount of liability, and they all have different tax implications for your business. What I would recommend is, if you are considering what kind of structure to have for your business, to talk to, if you have an accountant or a bookkeeper, talk to them. They will provide you good advice. If you don't, go and make an appointment with the Small Business Development Center advisor and talk through that specific topic with them.
Thank you for that. If you currently have active contracts, can you use this information to apply for a loan?
Sure. If you have active contracts, that helps. So that looks, that can show a lending officer that you may not have income at this moment, but you are under contract. So there also are some unique ways that some lenders can leverage a contract to help you get a loan. So there is something called factoring, where if you have existing contracts to perform for your business, but you need a loan to buy inventory or equipment or whatever you need to perform on that contract, there are some lenders or some entities that will say, okay, if you have this contract, then I will provide you a loan based more upon the credit assessment of that contractor or the vendor that gives you the contract, and their track record of paying and their ability to pay on this contract. So if they look like, okay, this lender or this entity that you've contracted with or that has contracted with you, if they have a strong track record of paying on time and getting things done, then they can say, okay, now for you as a business, we can help provide you this cash to help get this project done, provided that you show some expertise in providing this kind of service. And then if something happens, we can get paid by the contractor directly. But yeah, it helps. It certainly doesn't hurt you.
Thank you for that. Is the SBA guarantee fee paid by the lender or the borrower? Is that considered a closing cost?
It is. And so we don't really have any stipulations on whether the lender pays that fee or you pay that fee. In practice, the borrower always pays that fee. So we charge the lender, and the lender is allowed to pass that fee on to the borrower in the loan. So they just basically add that, and it's not that much. It can be a couple $100. It could be a couple of $1,000. They typically just put that into the loan, and they say, okay, your loan amount is this, and we've added in the fee. So it's relatively small, though.
Thank you. It was placed in a chat. Can you make an appointment with an SBDC advisor? Yes, you can. I dropped the link in the chat for convenience. Here's another question. If you are a trade name, You recommend to upgrade to LLC?
If you are, I'm not sure I understand the question. If you're a trade name,
Or if you are a sole proprietor? Or
well, and even if yeah, if you are a sole proprietor or really whatever you are, I don't just blanket recommend that someone form an LLC. It really depends on the nature of your business, and what you're doing, and the tax implications, all sorts of things. It's difficult for me to make a blanket recommendation like that, and I would just spend some time. If you have an accountant or bookkeeper, talk to that person. You can look online. There's lots of, like I said, you can spend a whole webinar just on that topic. There are lots of articles online that talk about how to assess the difference between a sole proprietorship, a C Corp, an LLC, an LLP, all the different types, and the pros and cons of each. But if you're still uncertain, just make an appointment with a business advisor and they'll be able to help you.
thank you. I don't see any more questions at this time, so I guess it's safe to sign off. So the SBDC has so much more in store for you SBI small businesses. You can visit our website at www.viSBDC.org. You can download the VI SBDC app on your mobile device from the appropriate app store. Like and follow us on Facebook, Instagram, Twitter, Google Business, and you can subscribe to the VI SBDC YouTube channel for new uploads of our on-demand webinars. Displayed on the screen, we have our training portal. You can register to attend events. So I just want to take this time to emphasize that we have an on-demand section that you can search events that we hosted in the past, and you can go ahead and watch those at your leisure. And if you need more information, we can reach out to us. We can email you a copy of the presentation, and we can connect you to the presenter if necessary. So back to some events that we have coming up. We want to make mention that we have a basic tree planting hybrid workshop. It's in collaboration with the Agriculture Business Center, and that's going to be on June 18th from 6 p.m. to 7:15. On June 18th, we're in collaboration with VBOC, Puerto Rico, and USVI. They're going to be presenting on the economics of small business startup. We have our SBA Senior Area Manager back again on June 24th. He's going to be presenting business resiliency as disaster preparedness. On the 25th, we have, in collaboration with the Agriculture Business Center, basic tree pruning. That's another hybrid workshop. It's going to be offered at 6 p.m. until 7:15 p.m. On June 25th, we have VBOC. They're going to be presenting Introduction to Business Planning. On June 26th, we have the Ripple Effect, How Small Steps Lead to Large Wins. On July 8th, we have SBA Senior Area Manager Wayne Huddleston back again. He's going to be speaking to SBA Federal Contracting Certifications. So I don't see any more questions. Wayne, it's always a pleasure collaborating with you on these initiatives. And we thank everyone for attending today's presentation. Here's a friendly reminder to fill out that training survey that lets us know how we're doing. So on behalf of the entire VI SBDC network, once again, thank you for attending and do enjoy the rest of your day.